Welcome, dear traders. Today, market sentiment is rather mixed. The stock market in Australia is climbing, while in Japan it's declining. Lots of factors are now impacting the equity market, such as political events and economic indicators, as well as investor fears and forecasts. Are traders now more realistic, or do they prefer to rely on hope? Watch our video review and find out. Last week, stocks managed to score large gains. For example, the main stock indexes on Friday reached a multi-month high. Optimism returned to the Wall Street after the release of the US inflation figures for October. Interestingly enough, the report may signal that inflation has finally peaked. It may also be a solid argument for the Fed to switch to a less hawkish stance. It seems that many investors came to such a conclusion last Friday, so stocks jumped to multi-month highs. For example, the NASDAQ advanced by 8.1%, logging the best weekly performance since March. Following the inflation data, the FedWatch Tool also indicated that expectations of a further aggressive tightening lowered significantly. Today, this tool still signals an optimistic scenario for stocks. The chance of a 50 basis point rate hike next month exceeds 85%. Some Fed policymakers also made dovish comments. President of Dallas Fed Larry Logan and President of the San Francisco Fed Mary Daly said on a Friday that it would be appropriate to slow down the pace of a tightening in order to assess economic conditions. However, on Monday, investors had to return to reality. After the speech of a Fed Governor Christopher Waller, he warned investors about getting too optimistic over one inflation report. He noted that the central bank still got a ways to go with the policy tightening. Yet Waller also admitted that the Fed may consider less sharp rate hikes at the next meetings. He said that markets should pay attention to the end point of rate increases, not the pace of each more. He also pointed out that the end point is likely still a ways off. The US dollar regained ground amid Christopher Waller's speech. After falling to 3-month lows at the end of Friday, it rose again. It was trading in the Asian session at 106.70. The US currency dropped by about 4% last week due to the CPI data and the risk-on sentiment. However, it's too early to talk about trend reversal. Nevertheless, not long ago, some analysts warned that aggressive sellers might fall into a trap. It looks like their predictions are starting to come true. The US dollar index also advanced against its 6 rivals. It began the week in a green price corridor of 106.50 and 107.00. However, it's still trading quite far from last week's high of 111.30. The yen was able to grow thanks to the US dollar's retreat at the end of the last week. If we compare the pairs exchange rate of 146.50 before the release of a CPI data and its movement at the start of this week, the difference is quite impressive. On a Monday, the dollar-yen pair is trading at 139. It's moving steadily between the resistance level of 140.30 and the support level of 138.40. However, the pair is growing again. It has already approached 140.30. Apart from the comments of Christopher Waller, the yen lost momentum because of the Bank of Japan governor's speech. Today, Haruhiko Kuroda vowed once again to stick to an ultra-loose stance. We are at a stage where we will continue monetary easing to firmly back economic activity at present, he said. Therefore, the yen is likely to face bearish pressure as soon as the US dollar finds more positive fundamental factors. The yen is likely to begin to depreciate as it did today. The Australian currency is climbing today despite an increase in the greenback. It's extending gains even ahead of the employment report and the Reserve Bank of Australia meeting minutes. As a reminder, earlier this month, the central bank raised the key rate by only 25 basis points. The RBA decided to slow down aggressive tightening at the time of a historic surge in inflation in the third quarter. Later, Reserve Bank of Australia Deputy Governor Michelle Bullock said that interest rates would remain high for some time. However, the watchdog may soon move to a softer stance. Investors are sure to find out more details in the minutes. Positive external factors also pushed the AUD-USD pair up. China is planning to ease some COVID restrictions. Oil prices are also grabbing amid improving sentiment in China, and this is rather bullish for commodity currencies. The Aussie was moving in the Asian session in the intraday range of 0.6664 and 0.6726 and even managed to break above the psychologically important level of 0.6700 for a short time. However, a bit later, the Aussie rolled back to 0.6687. So, bearish pressure will prevail as long as the US dollar maintains bullish momentum. The New Zealand dollar is showing a similar dynamic. After a more than 3% rise last week, the Kiwi also dipped on Monday, trading in the bearish corridor of 0.6064 and 0.6133. The local central bank stressed that inflation remains high and the labor market is weakening, so it's hardly surprising that the Kiwi is declining now. The NZD-USD pair has already approached 0.6090. As we can see, the words of even one of the policymakers can greatly influence market movements. One could only imagine the impact of statements made at the G20 summit during the planned meeting of Joe Biden and Xi Jinping. So, in the near future, political events will mainly affect market sentiment. Apart from that, the US will reveal the retail sales report, the producer price index, and the housing market data. This week is going to be rather eventful. It's crucial to have the actual market news at your fingertips to make a profit. Subscribe to our channel and keep close tabs on the latest market developments. See you soon.